What's up? Alright, so this is going to be a video specifically for a friend of mine who's asking about some financial advice. He has some money in the bank and he's not really sure what to do with it. He really would like, obviously, for that money to grow, but his situation, of course, is different, as is everyone else's situation when they have money. When do they need access to it? Are they going to have to rely on it after a certain period of time? So what am I really talking about here? I'm really talking about what to do with your money and what level of risk is acceptable for you. Okay? Everyone's level of risk is going to be a little bit different. Me, personally, I have no real expenses I have to worry about. And on top of that, I'm not planning on using my money, hopefully, for another 10 to 15 years. So what does that mean when it comes to what I put my money in? It means that I take risks that I would not recommend almost anybody else ever do. So I could discuss like what my specific investments are, but I don't really see a point to that because the amount of risk I take on with these investments is just stupid. It's really stupid. I hope that the payouts are really big. Occasionally they are, but it's stupid. Okay, so for my friend in his case, the amount of risk that you can take on comes in many different levels. In the world of investment, when we talk about different levels of risk, what we're really talking about is the chance to lose money, or the chance to not make as much money or make more money than the stock market. So what am I really talking about? Inside the world of investments, there's something that's called zero risk, or relatively zero risk. And what that is U.S. Treasury bills, Treasury bonds, anything basically traded by the U.S. Treasury. So the return on these items is usually extremely small because it's proportional usually to the amount of risk that you're getting. These items usually return a slightly better than savings accounts inside banks. So I would say a bank savings account nowadays probably goes for like maybe a little bit under 1%. These are going to return 1% to maybe 2% if you actively pay attention to them and trade them and so on and so forth. And maximize the value out of them. That's what I was really trying to say. These items I would really only recommend if you know that you're definitely going to need your money, you know you're definitely going to need it after the year, you really can't afford to be losing any of it because you're going to be sending or need exactly that same amount. Okay? So let's talk about things that are a little bit higher in risk, okay? Like next up on the list for me is usually bonds. Specifically bonds of very well-known companies with long histories. Bonds with companies that have never had a problem paying them. So, bottom of the rung, U.S. government. Next up, we have corporate bonds, okay? Now, there's a chance that companies can default on bonds, but the chances of that happening is not often at all if the company has a long history of being around and you're not investing in something that has a long history but is currently fading due to technology problems, up-to-date problems, management problems, so on and so forth. So what am I really talking about? I'm talking about Walmart. I'm talking about, I want to say Bank of America and other financial institutions of that kind, like Citibank, but the truth of the matter is that in 2008 we had a financial crisis, so those might seem a little bit scary to some investors. Personally, I would not worry about them, but that's my own opinion, my own 2 cents. Moving forward to some things that have a little bit more kinds of risk, without going into specifically the type of bonds and explaining all of that. Next up inside our risk category would be stocks. Okay, so inside the world of stocks, there's lots of different options. There's obviously a million companies, a million different tickers. Where should you put your money? Well, my personal recommendation for those that do not actively watch and seek out and analyze stocks would be just put it inside the market. Put it inside the S&P 500. put it inside a low-cost index fund. Low-cost index fund is just let's start. An index fund is an entity, if you will, that comprises entirely of something, whatever it wants to be comprised of. In some cases, it's value stocks or growth stocks or a specific type of stock, energy stocks, internet stocks. Okay. In this case, when we're talking about a market fund, we're talking about a fund that literally is the market, or the S&P 500. The S&P 500 is what is generally considered to be the best market or best economic indicator, excuse me. And when people talk about, oh, how's the market doing today, they're talking about the S&P 500. A lot of investors attempt and try to beat the market and fail. Some also do succeed. So realistically, the S&P 500 is 500 of some of the largest and mid-sized companies inside the United States that we use to determine our economic health. And it just so happens that these 500 companies are extremely reliable, have been around a long time, and generally are a great investment. So let's move on to the next part, and that is low cost. What I mean by that is some people who do index funds charge more than others. Generally nowadays it's pretty competitive. Personally, if I wanted to just invest inside an index fund, I would be picking SPY. That's the ticker for it. And what that really is just a general long-time, low-cost market index fund. So, personally, it is a riskier investment. And this is specifically advice from my friend, not so much the general audience out there. I know how he views risk, and I would say that generically, when I give advice for investment, I just tell people to put it into the stock market fund. You continually put it in there, and it's just the best way to accumulate wealth. Well, it's also a way in which you can lose money. Let's be realistic here. The market does fluctuate with time, and currently, as of June 13th, 2014, we are at one of the all-time highs for the S&P 500. What that really means isn't much, but the real reason why I bring it up is it's much safer to invest money right after a crash. It's also much safer to bet against the market when it's at its high. And, well, we're at its high. This by no means is supposed to indicate that I believe that it won't go up given more time, or given even until the end of this year, because I think it will, due to lots of other indicators, lots of other factors, which I'll go into in another video. But this is just to say that it's not a not risky time to invest in the market. How's that for a summary? Okay. So those are generally the normal levels, right, of risky investments, and of course the more risk that you take on, the higher your potential return from your investment is going to be. Okay, so we have US bonds, bills, treasury, right? Bonds, corporate, large corporate, not small corporate. Okay, and then we're talking stock markets. So the other things that you can get more potentially return from, but much more risk, would be different different funds comprised of different things. And then of course you can get into options, which is basically leverage trading. And that's realm where your risk is, of course, through the ceiling, but your return is potentially really great, especially if you know what you're doing. Anyways, those are my levels and my current advice, my general advice for everyone is to invest in a low-cost index fund. No matter how risky the market is, just keep storing it away. The average return is going to be 9 to 10%, and even if the market crashes, you're not going to be hit terribly. Some of the biggest crashes have been 30 to 33%, and if you look at it over the long term, it's not going to kill you. Just make sure that you're okay with losing 30%, 33%, basically a third of the money you're investing at the worst possible time. So as long as you're comfortable with that, you will make it out more than fine, and you can become very wealthy over time. So I think that's going to be it for now. I'm going to be doing another video pretty soon, specifically for my friend, showing how to trade inside a Fidelity account, how to trade the various different assets that I've just talked about, being, stocks and bonds. And hopefully this advice will help you a little bit to figure out exactly where you are looking to invest your money. Thanks.